Welcome back. Now, CLSA in a note today says the recent pause in US dollars rally could be a relief for emerging markets. Hormaz has more details on this note. Hormaz.
A temporary reprieve as such coming in with the fall in the US dollar that we have seen in the month of February. It's now slipped to levels of 106 from earlier levels of 110 now, almost down 2% in the month of February itself. And CLSA is calling it the same. It's calling it a temporary relief, and that may favor emerging markets going forward. And according to long-term associations, the US dollar is now almost 30% overvalued compared to the net savings rate, is what CLSA is saying. And we all know about Donald Trump, the US president, and his preference for a weaker dollar, but his policies of tariffs and all of that is suggesting otherwise for the trajectory for the greenback. And the CLSA also goes on to say that the US dollar remains the most critical mandate for foreign funds and their appetite towards emerging market stocks. Now, not only is for the savings rate, the US dollar is also overvalued compared to the US 10-year yield, almost 3%, and also 12% compared to the GDP growth differential for the United States, is what CLSA has to say. Now, going forward, some other wild cards for the dollar: the more aggressive tariffs and geopolitical tensions, that will be a positive. But in case if there is political interference with the Fed and its monetary policy, that can be a negative for the US dollar. But for now, there is some temporary relief coming in with the fall in the greenback.
Thank you so much for that, Hormaz, for joining us and giving us a sense of what is CLSA's view.